Happy Wednesday out there, Team 42. It's your skipper here, Darius to present our macro minute for Wednesday, October 16th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro questions are, does the Fed still have an asymmetrically dovish reaction function? And will Donald Trump spoil the Goldilocks party? Our answers are yesterday, Atlanta Fed President Raphael Bostic's comments were supportive of the Fed's asymmetrically dovish reaction function. He expects both growth and the labor market to remain robust and inflation to be choppy. We interpret his choppy comments as members of the Fed already preparing to look through upside inflation surprises in the coming months. We've maintained our view that the Fed is operating with an asymmetrically dovish reaction function for nearly a year amid our J wants a soft landing theme, which has been our North Star fundamental view. For what it's worth, stocks, S&P 500 and Bitcoin are up 35% and 94% since then. Yesterday at the Economics Club of Chicago, Donald Trump quadrupled down on his plan to raise tariffs to 10% across the board and to 60% for all Chinese imports. He also doubled down on his plan to cut taxes. From our data-driven vantage point, it's Republican policies like the Trump tax cuts that are flying way too under the radar in terms of contributing to the elevated risk of a fiscal crisis in this fourth turning. In case you missed it, our investing during a fourth turning regime analysis is arguably the most important political analysis in the world right now. Consult our latest macro scouted report for more details. Transitioning to our 42 macro dashboard here. As always, we'll wrap up with a question from our community. This one says, does it make sense to sell TLT even after this last correction? It says, hi, Darius. Thank you for your great work. I'm a newbie here and I missed the call to take profits in long-term bonds, TLT in my case. After this huge correction in TLT recently, does it still make sense to sell everything? Or in this case, would it be less detrimental to rate for at least a pullback, for example? So our general take on this, and just from a risk management standpoint, is it is never a bad day to align your portfolio with what the market is trying to price in market regime terms, right? When you think about, perhaps missing a signal like the one we issued in TLT literally almost a month ago to sell TLT, that was at what was the year-to-date high in TLT. If you miss that signal, that does not necessarily, that has no bearing on the fundamental, the forward-looking risk in asset markets. The forward-looking risk in asset markets is a function of what is the market going to try to price in over the medium term. And ultimately, based on our fundamental research views, we are expecting the current Goldilocks market regime to generally persist over the medium term. April, second quarter of 2025 is roughly around when we start to think that Goldilocks to come under some pressure from a litany of factors, not the least of which is, upside surprises at inflation causing bond market volatility, which could, put the kibosh on global liquidity from a momentum standpoint. We could also see a significant retracement in what is likely to be a significant spin down in the TGA in the first quarter of next year. We might see a significant retracement in the TGA in the second quarter of next year, building that back up from roughly zero by the end of the Q1 of next year. So you could come into some real turbulence in asset markets starting in the second quarter of next year if our fundamental views on sticky inflation are right and our call for the TGA spin down to accelerate markedly starting January 1st kind of starts to reverse after the debt ceiling is negotiated. So those are two big headwinds that we see over the medium-term time horizon starting in the second quarter of next year. But at the end of the day, it's Wednesday, October 16th, 2024. And if we remain in a Goldilocks market regime, generally speaking, between now and then, investors need to be aware that long-term treasury bonds are going to be one of the biggest opportunity costs, one of the worst possible places you could be parking your capital. It doesn't necessarily mean they might lose a lot of money in value in price terms. Again, the Fed is still cutting the interest rate, the policy rate. The Fed still has asymmetrically dovish reaction function, and growth is still slowing. And so at the end of the day, it may not equate to losses, but what it will equate to if we remain generally in a Goldilocks market regime is that you're going to be underperforming practically every other asset in the world. So with the exception of cash. So why would you be long an asset that is underperforming practically every other asset in the world in that context? And so that's what we mean by right-sizing your portfolio to what the market is likely trying to price in. And how we figure out what the market is trying to price in is obviously through our global macro risk matrix, which is our market regime nowcasting process, which, if you go and you study the backtest, our out of sample backtest for that market regime nowcasting process, 97% of the S&P 500's return since January of 1998 has come when our market regime nowcasting process has identified global macro markets are in a risk-on market regime. 109% of Bitcoin's cumulative performance since the inception of the asset class has come when our market regime nowcasting process has identified we're in a risk-on market regime. Those statistics are essentially flipped for things like treasury bonds and the US dollar, which are defensive assets, which tend to go up when we're in a risk-off market regime. So investors need to be aware that if you are respecting the evolution of the market regime, you give yourself, your portfolio, your family, your clients' families, your bonus, if you're on the buy side, you give yourself the best opportunity to compound returns across time. So you can either choose to respect the market regime, or you can disrespect the market regime and just say, hey, I'm going to wait it out in something and that may not make money or perhaps lose money. And at the end of the day, that's a choice you have to make as an investor. And, you know, if we're grateful for the thousands of investors in the world that have chosen a better way here at 42 Macro. So we'll wrap it up there. Darius Dale here presenting our Macro Minute for Wednesday, October 16th, 2024. Best of luck out there today. We'll catch you back here tomorrow. Cheers.